Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report so fresh it's practically still printing. We're looking at Live Oak Acquisition Corp V. Now, before you switch off thinking another boring finance report, let me tell you, this one has all the ingredients for a good story. Big money, blank checks, and a race against time. Scroll date of report date. Of earliest event reported, February 27, 2025/scroll. This report is an 8K, a current report. It's basically a snapshot of major events that a company needs to tell investors about quickly. The most important date here is February 27, 2025. That's the date of the earliest event they're reporting. Scroll item 1.01, entry into a material. Definitive agreement/scroll. The big news, Live Oak Acquisition Corp V just completed its initial public offering, or IPO. Think of an IPO as a company's debutante ball, where they offer shares to the public for the first time. They offered 23 million units at $10 each. This brought in a cool $230 million before expenses. Each unit isn't just one share, it's a share of stock plus half a warrant. A warrant gives you the right to buy more shares later at a set price. In this case, $11.50. This is important because it can dilute the stock, or in other words, make each share less valuable if lots of people use those warrants. Scroll and underwriting agreement. Dated February 27, 2025/scroll. To pull this off, they needed help from the big banks. Santander US Capital Markets was the underwriter. An underwriter is like the party planner for the IPO. They help the company sell the shares. There are several agreements like the underwriting agreement, the warrant agreement, or investment management trust agreement, and many others. These are the legal contracts that make the IPO happen. They define everyone's roles and responsibilities and protect investors. Scroll private placement warrants. Purchase agreement/scroll. Here's where it gets a bit more interesting. There's something called a private placement warrants purchase agreement. This involves the company selling warrants to a special group, in this case, Live Oak Sponsor V, LLC. The sponsor is usually the team that sets up the whole blank check company in the first place. Scroll item 3.02, unregistered sales of equity securities/scroll. They sold 4.5 million warrants to the sponsor at $1 each, raising another $4.5 million. These private placement warrants are almost the same as the warrants sold to the public, but were sold in a private deal, meaning they didn't have to register them with the Securities and Exchange Commission or the SEC right away. The money from the sale is important for the company to make the deal happen. There are changes to the board of directors, the people in charge of making the company's big decisions. New people like Messrs. Hudson, Fuhrer, and Ms. Tarbox are joining the board and its committees. Board members are appointed to the Audit Committee, which checks the numbers and makes sure everything is honest, and the Compensation Committee, which decides how much the top executives get paid. The company also updated its amended and restated memorandum and articles of association. Think of it like the company's constitution. It lays out the rules for how the company operates. Now, where did all that IPO money go? A total of $231,150,000 is sitting in a trust account managed by Continental Stock Transfer and Trust Company. A trust account is a safe place to keep the money until it's needed, and this money can only be used for very specific things. The clock is ticking. Live Oak Acquisition Corp V has a deadline, a time limit to use this money. They have 21 months, almost 2 years, from the IPO to find a company to merge with. If they don't, they have to give the money back to the investors, and the whole thing falls apart. The company also issued press releases to let everyone know about the pricing and closing of the IPO. Public companies must keep their investors in the loop, so they need to make sure they announce it to the public. So what does all of this mean? Live Oak Acquisition Corp V is a special kind of company called a SPAC, or Special Purpose Acquisition Company. Basically, it's a blank check company. It raises money through an IPO with the sole purpose of finding a private company to merge with. Think of it like this. Live Oak is a treasure chest full of cash, searching for a company to buy. The pressure is on to find a good target within the deadline, or the treasure gets returned. Now, let's take a step back and look at the bigger picture. What are the strengths and weaknesses of Live Oak Acquisition Corp V based on this filing? On the plus side, they've got a substantial amount of cash, $231 million, ready to be deployed. That's a big war chest to find a suitable target company. They also have experienced people on the board of directors as well as having the backing of Live Oak merchant partners, but there are also risks. The biggest one is the ticking clock. They have a limited time to find a target company. If they don't find one, they have to return the money. This puts pressure on them to make a deal, even if it's not the best one. Also, the warrants they issued could dilute the stock and reduce the value for shareholders. Another thing to keep in mind is that the SPAC market has cooled off a bit. There aren't as many companies looking to go public through SPACs as there used to be, so the competition to find a good target company is fiercer. Overall, Live Oak Acquisition Corp V is in a decent position, but they face real challenges. Their success depends on their ability to find a high-quality company to merge with before time runs out. The next few months will be critical. Thanks for watching this Corporate Decoder episode. If you enjoyed it, please like, comment, and subscribe for more deep dives into the world of finance.